Hi, I'm Hedgeye founder and CEO Keith McCullough. I'm excited to announce the Hedgeye on the Prize tournament. I challenge you to compete in this simulated investing tournament to win some serious money. We'll be awarding weekly and monthly cash prizes along with the big grand prizes. Along the way, we'll teach you how to take your investing to a whole new level. I hope you'll join us. I'll be coaching you every step of the way. I'm Keith McCullough and welcome back. Round 3. I hope you've enjoyed the conversation so far. I certainly have. The goal here is to, again, try to find something that at least wasn't in my thick craw. And this guy in particular, Mike Green, you find a way to do that very consistently. So thanks for joining me again. We appreciate it.
Oh, Keith, thanks for having me back.
I think we have Mike. You guys have his. We good? Is it my pack? Just one second here. First technical difficulty that I have here. Mike, you there?
Can you guys hear me?
Oh, I got you now. So again,
okay.
I have to embrace the uncertainty here. I didn't know if I was going to be able to hear you there for a second, but maybe let's just start with that. You and I were just talking offline. You know, in this world that we're in, which is increasingly volatile on a lot of different fronts. You and I, and we will spend some time on that, market structure, et cetera. What do you think about what's going on?
Well, I mean, this is what we were talking about before. You said embrace the uncertainty. Part of what I'm struggling with right now is that the path forward is very uncertain, right? So if I look at kind of how I'm thinking the world looks, I would suggest it looks an awful lot like the fourth quarter of 2018. You've had a recovery in demand for commodities. You've seen the structure of the world effectively that in 2015, 2016 was all about a dramatic slowdown in the Chinese economy, which of course hits the demand for things like oil, copper, et cetera. That began to recover. You began to see the limits pushed up against, and if you had actually looked at the price of natural gas in the fourth quarter of 2018, or the price of oil in 2018, yep, or the level of interest rates in 2018, they were all indicating that things were "quote unquote" getting much better, and then the bottom kind of fell out, right, mm-hmm, for a variety of reasons. We've seen similar time periods in 2010, coming off of the 2009 recovery, where there was a pause in the market. It feels very much to me like we're in that sort of situation. And I think anyone who expresses certainty around what's transpiring when we have the dynamics in play in China, where growth is very clearly slowed, both on a cyclical and on a structural basis. In the United States, you're beginning to see evidence. If you look at home building stocks, they are very clearly rolling over in a way that is very similar to what transpired in the fourth quarter of 2018. Transportation stocks have been weak now for give or take 5 months. You're looking at a lot less certainty around the idea that this is going to recover sharply. And so, do we get a cold winter? Entirely plausible, right? Certainly forecasts for an El Nino would suggest that in Europe and the United States, there's going to be excess demand. On the other side of it, you and I have been doing this long enough, and people always say this, and they always kind of are unwilling to accept it. But the cure for high prices is high prices. Yeah. Instead of the stimulus now coming through and showing dramatic increases in purchasing power for households, we've actually seen declines in purchasing power for households. And that's in the United States. Go to the emerging markets, it looks terrible. I mean, I would direct people, I've been focusing my own internal team to start to think about emerging market FX. If you look at the Thai baht or the Korean won, right? The Thai baht is almost the one that I would really focus people on. About every 13 years, you get an EM blow up, something goes way off the rails, and the Thai baht falls apart. And we're almost exactly 13 years after, the last cycle in 2008. And I don't want to put numerology on it in any way, shape, or form, but it just feels like that's an area that people aren't paying attention to, is the incipient weakness, in particular in Asia, and the risks that exist around the delivery of commodities, the demand for commodities, et cetera, if something heats up in the South China Sea.
Yeah, the inflation piece we've had. This is my 6th discussion in 2 days, and I think and again, we'll feel free to illuminate your thoughts on that topic. But I don't think everybody here is running around saying, I've been positioned for deflation and that's working out fine. On the other part, though, I mean, I wake up first of all, I wake up in the morning and I've been short China since the beginning of the year, so that's worked out nicely. But, on the other side of it, we have India, which goes up every day. I mean, you have some divergences in Asia. There are things that, very few things that can be long in Asia, but, South Korea short, China short. These are big things that don't always have to agree with either the Indian cycle, which we have in Quad 1, or in the U.S. cycle. Now, that all said, I deal with uncertainty all the time. There's a knife's edge between Quad 4, which is what happened in Q4 of 2018, to your point, and Quad 2, a reacceleration in the U.S. with a reopening, COVID case counts falling. I could go both ways. I've currently gone one way, which is long. I've stayed long commodities. I've been there for a while, but I'm back on the growth train, and I'm rather uncomfortable about it. I mean, after a day like yesterday, that'll make it pretty uncomfortable. I got my ass kicked on that side of the book, not on the inflation part. And for me at least, Mike, it's like, and you know this because you've done it your whole career, but people that haven't run real money, they don't get it. You got to lose a little money to figure out, or a lot of money to figure out you're fucking wrong. And days like yesterday, I thought, okay, I might have this wrong. I might be wrong. I could always be wrong. What do you think about that, and what do you think specifically about not seeing a reacceleration with the inverse of COVID case counts falling like they are both globally and locally? More so, I'm more concerned about the U.S. because I think China, South Korea are certified train wrecks. I don't really have much debate on that.
Well, I think that's actually one of the biggest things, right? So, I mean, if you're going to talk about commodities and the general inflation dynamic, there's two ways to think about China, South Korea, et cetera, right? That is the supply center for the United States. And so if it truly falls apart into chaos, then accept it. You're not going to get your deliveries of X, Y, Z, right? And that is going to contribute to shortages and pricing power for those who can continue to source. But what we're really seeing in a lot of situations is that companies are increasingly unable to source in the absence of that. And so you would simultaneously see higher prices and a decrease in supply, meaning that less demand gets filled. You don't get to go to your restaurant because they actually just don't have the stuff to sell to you, right? Restaurant is a bad example. Car dealer would be a better one. That is a very real concern that results in a decrease in economic activity. And I would just suggest, that it is truly stochastic. The danger in looking at charts, the danger in looking at history is that the decision has been made, right? The dice has been rolled. We know if it came up Yahtzee or if it came out, something totally different, right? And we're able to interpret that as, well, there's a defined cycle, right? Yes, the probabilities of a reacceleration are certainly higher. And, my good friend Mike Taylor would point to what I think is one of the best looking relative pairs out there, Live Nation versus LYV is the ticker versus Moderna, mRNA, right? Like, that has been an absolute disaster. The idea that people are not going to want to go to concerts, are not going to want to go out to eat, are not going to want to engage in services that largely fill the opportunity for social interaction, to me feels very silly. I know that my inbox is filled with requests for concerts. My daughter just went to the Governor's Ball in New York as her birthday present, right? So everybody wants to be involved in this component. But that's actually pretty low commodity intensity, right? I mean, maybe pork demand for the hot dogs that are sold at the stadium, but it's not the exact same thing as reopening an economy on an industrial basis. On the industrial side, I would point to today's PMI, or the past couple of PMIs, as having something really interesting in them, in that an increasing fraction of the demand is actually going to inventory restocking. So while we're seeing the levels of production remain relatively restrained, although at very high levels in a PMI context, the amount of that demand, that's the new orders effectively that are going into rebuilding inventories, is substantive. And that's telling you that end demand is actually weaker than what we're seeing in the new orders component, right? And ultimately sets up a stage for a plateauing and a rolling over. So I'm in the camp that says there's certainly a risk of inflation, but I'm also I would just say very, very cognizant that it is, as you point out, a knife's edge, right? We just don't know, and particularly as it relates to commodities, I'm very focused on what's happening in China, and I'm watching FX to kind of help me determine where I think that's going.
Yeah, the closer you are, and I agree with most of that. Copper, for example, like I'm not long copper. Why am I not long copper? It's the closest to China. It's got the biggest demand component, and they sell 30,000 fucking tons in a day. And they tell you they're going to do it. They did it on September the 1st. So why would I buy that when I can be long coffee, which has a supply-demand imbalance, and it's still trading inversely with my dollar pair? There's a lot going on there, but anybody who's ever traded commodities should always feel like they're on a knife's edge. Let's just start with that. Yeah. I mean, most people our age, or certainly younger, don't even know that that's an asset class.
To be entirely honest, in the scale of Western development, it's not actually an asset class, right? I mean, it's tiny relative to the other asset classes that we talk about, right? On that front, exactly as you're highlighting, the natural outcome from much higher natural gas prices has been spiking fertilizer costs and shortages of nitrogen fertilizer in particular. Nitrogen fertilizer plays directly into the softs, the wheats, the coffees, et cetera. And there's a very real risk that is the area, which is a tiny fraction of the Western budget, right? As much as we want to talk about food in the context of what you see at the grocery store, the reality is that the vast majority of stuff that we buy in the West is heavily processed. There's 2 cents worth of corn in a cornflakes box. Now, I was talking to David Einhorn yesterday. Hopefully some people got to see that. And David points out that a lot of the pieces of the cornflakes are rising. One of the inputs into cornflakes is the natural gas that needs to go into the dryers to take that, wet corn, that ground up corn, and turn it into an actual flake that doesn't fall apart on your spoon. So there's a lot of components that are feeding through, and I do think we'll see higher prices, but your box of Frosted Flakes may go to, from $4 to $5 to $6, but it's not going to $40. It's just not going to happen.
And those, by the way, I haven't talked to Einhorn this week or last, but I mean, those are the companies I'm short. I'm short consumer staples with this input costs, particularly on the labor side. I mean, these guys have relatively no pricing power, which is basically your point. You're not going to sell a box of corn, but I could sell you a barrel of oil for where the futures are trading. I mean, that's the point. I'd rather be long the commodities and I'm short anything, consumer staples, Clorox. I mean, things that are melting ice cubes like Verizon. Anything that has no pricing power but rising labor. It's been a great environment, actually, and a non-defensive one at that. Like in Quad 4, by the way, those types of assets tend to do better, but they've acted like shit. I mean, because bond yields have broken out. But back on the point that you made on your daughter or the services economy on slide 58, this is why I'm leaning more Quad 2, and it's only recently and uncomfortably so, I might add, which I've already said, and I don't think I need to say that for people to have confidence that I don't have any. But on the right side is what you said, which is what happened. You get durables as the baby blue line, and the services line is barely moved. But the probability of the services consumption line in the U.S. economy in the fourth quarter not accelerating versus the slowdown we saw with the Delta variant, I think it's pretty low. I mean, I don't have like 100% conviction or 80% probability, but consumption in the fourth quarter with the holidays and a reopening, how could that be wrong?
No, I broadly agree with that. I mean, I would highlight exactly that point, which is
that's the Mike Taylor view too, by the way.
That's the Mike, yeah, exactly, yeah. That's the point that I was highlighting. If I compare those two, right? Moderna is obviously the extreme version of the pandemic stock, right? But if you look at something like Live Nation, which is actually sitting at all-time highs or very near all-time highs, the reality is that they've emerged from the pandemic with no competition, with increased barriers to entry because of the need to run sterilization procedures, the inability to get anything built, the inability to expand capacity. And every band on the planet wants to get out there and tour, right? I mean, talk about how you're going to benefit from it. Your cost of input, which is basically, getting bands that are desperate to go increase their touring revenue and move away from, pseudo Zoom calls to actually in-person events. They're not going to do it for free, but man, their negotiating power has been dramatically reduced when everybody has been off the road and everyone wants to get back on it, right? So, and everyone wants to go see them at the same time, right? Talk about pricing power. That's a fantastic example. And I have no position in the stock. I'm not trying to pitch Mike's position or anything else, but I do think that is one of if you pull up that chart in that pairs trade, that is one of the more indicative charts to me of what could very well happen. And the other point that I would make on that services side is that is one where you are seeing the shortages of labor, right? So you'll end up with my guess is less unit purchases, right? So you're not going to go back to the same degree of people dining out in restaurants, et cetera, because there's just not as many restaurants, there's not as many servers, there's not as many people who are, capable of washing the dishes, et cetera. But we're going to work our way through that. And the companies, and this is a theme that I've highlighted throughout the pandemic, companies that are in the position to invest in the automation, et cetera, to improve the experience, to make it more automated, to replace paper tickets with electronic tickets, to have COVID protocols in place, they're just better positioned.
Yeah, I mean that's why I'm so excited about being a Canadian American capitalist. I guess I'll use the abbreviation, but I mean there's a lot to do out there. I mean there is a lot to do on both the long and the short side. However your positions play out, there's certainly a lot to think about. I want to switch a gear here to where very few people can have a real conversation out loud about it like you can, which is market structure, options trading, the uncertainty of it all, or what I call episodic and non-trending volatility. It's not like I made that up. Obviously, you can, if you read Gatherall, you read Mandelbrot, you can figure out that's the whole point about fractal dimensions and fractal patterns, is that they either continue to repeat themselves and you get a real explosion of volatility, or you don't. Now we've had a variety, almost a monthly, actually in fact in 1 to 3 day windows, U.S. equities in particular, where all the emotions are, and all the a lot of delta hedging, and maybe just explain that for people. But what do you see relative to what I've spent a lot of time trying to explain on the why, which I boil it down to leverage, lots of leverage, and a lack of liquidity in the hedge fund business. What do you see there?
Well, I think the hedge fund business is harder in part because what started out as a very, very strong year, particularly on the reflationary thesis, where most hedge funds did really well, has now become a little bit dicier, right? And so I think hedge funds are a little more cautious heading into the fourth quarter. In general, use of leverage seems to have been reduced. There's weird dynamics that are playing out in the equity hedging space. Yeah. Everyone's familiar with the high levels of skew, the elevated levels of vol. In my view, there's two primary components to that. One is that people are genuinely worried, right? So the demand for hedging is higher than it has been historically. And that's true on both sides, right? Shorts are terrified of being short a convex security. And as a result, call overriding strategies on a discretionary basis have deteriorated at the same time that the same strategies in forms of hedged equity, et cetera, have expanded, where people will sell a 3% out of the money call to buy various put components to protect against the drawdown, right? When you have that sort of robustness in the market, it becomes harder to have those drawdowns. Mm-hmm. At the same time, everything that we're talking about in terms of the rotation in structure in the economy, Microsoft is not really going to benefit if people start going to concerts, right? If anything, you're going to see the opposite. And those giant stocks, the Facebooks, the Microsofts, the Googles, et cetera, they are losing a little bit of strength. Mm-hmm. And it's very similar to what you're talking about with consumer staples, right? Those have effectively become the new consumer staples. When faced with a world where you have to stay home, everybody needs to have access to their computer. Everybody needs to have access to streaming services. Everybody needs to have access to Zoom or the equivalent Skype, et cetera. All of those are effectively the new consumer staples where demand is stable. Pricing power may not be extraordinary. Microsoft is not going to turn around and double the price of Windows or Microsoft Office, but the actual pattern of demand allows them to add just a little bit or cut costs a little bit every single year. I'm seeing less, Microsoft has rolled over a little bit for the first time in a long time. Google is showing similar dynamics. Facebook obviously has significant risks suddenly from a regulatory framework that have accelerated with recent revelations. So the kind of broad indices component, my bias is that we're going to probably trade sideways in a consolidation through the fourth quarter. But I just don't see, I don't see the catalyst that creates the big sell-off. Unless it is China.
I mean, China, like I say, if you're bearish on China, fucking short China. Enough. It's like, right. I mean, and a lot of people who purport to be the experts on how bad it is in China haven't been short China. So I don't understand that either. So I'll just do my own version of China. But on delta hedging specifically, like we see, and we just saw it, let's use the examples that you just used. We see these ballooning implied vol premiums after a couple days of selling, and now, all these neutral books who have to maintain neutrality are almost like giving up money. It's like, I have not seen this before, having spent basically my whole career in the hedge fund industry before starting Hedgeye, hence Hedgeye. If you could look inside it, what would you see? I'm like a little, like almost like you talk about uncertainty. When I trade a market, I usually walk into it saying, okay, this looks pretty straightforward, but it's like I'm looking over my shoulder, second guessing myself, is this really like there? Into options expiration in particular, and that's been monthly.
Well, the thing to remember about this, so people always hear about this, delta hedging, gamma hedging, et cetera, right? So the closer you get to expiry on these very large hedged equity programs, right? So I referenced the idea of selling a 3% out of the money call to finance a down 10% put, for example, right? That's a way of taking your equity exposure and turning it into a quote unquote lower risk, lower return format where, you're basically saying, look, if I can make 3% a quarter, I'm very happy with that, but I can't handle a catastrophic drawdown. It feels like the perfect boomer positioning, if you really think about it, right? As you approach those expiries, from a dealer standpoint, how close you are to at the money can have a radical impact on what their hedging structure is. So remember, if I am a fund and I have sold a 3% out of the money option at the start of a quarter, and at the end of that quarter, we're basically sitting at that point, right? The dealers are long those calls by definition. They don't really want to take a directional position. So the natural, hedging vehicle is I've received a call, therefore I'm going to short a fraction of the market. As we get closer and closer to that point, it becomes more and more gamma centric, effectively unstable, where on either side, those calls are either in the money or they're out of the money, and that can change that impact dramatically. I think that's a big chunk of what we keep seeing, right? That's happening around those option expiries. And on the flip side of that, the other thing that happens is, again, imagine you've now hit expiry, right? So September 30th was a reasonable expiry point for some of the larger hedged equity programs, which run typically not on the monthly expiry, the traditional September 21st sort of thing, but instead on September 30th. If you think about that position as it expires out on September 30th and then reinitiates late in the day on September 30th, that leaves the dealers much longer than they normally would. It creates selling pressure. It feels like that's what just happened, right? That the dealers effectively went out and hedged those exposures. Is this everything? And I mean, this is one of the things that is really, really important that people always understand. Like, that is what occurs in the absence of substantive information that forces people to change their fundamental positioning, right? So obviously that behavior is not going to be dominant around the events of a coronavirus, but in the absence of that, that's a big flow. It's a really, really big flow. And in a market that is increasingly passive and increasingly insensitive to price change, right? Because the price goes down, Vanguard's not going to buy anymore, or Vanguard investors aren't going to buy anymore. That leads to this sort of option dominance that, Lily Frankus, for example, is extremely well known for highlighting that type of dynamic.
Well, it's and you got all the dynamics. Certain major asset managers like Fidelity have September fiscal year end. There's a lot going on, a lot of flow. But again, it's like, to me, it appears like the thing that will not go away. Again, there's more leverage in the system than ever in human history. You've written about this too, in terms of loan to deposit ratios. Like, who else can we give money to take up their leverage upon? And we've also taken a hedge fund industry and said, look, everybody runs factor neutral. In a year where you should have been factor biased, you should have been long, high, short interest. Long. I mean. So to me, it's a very interesting year. Like, to me, the blow up risks in markets that won't go down by a lot of these flow issues. I mean, they resolve themselves through flow, not through fundamentals all the time. Then we get earnings season, may or may not resolve certain single stocks. But, when you get into the big kahuna, which is you don't know who's going to blow up next, it's not like we haven't had some major ones. I mean, Bill Huang in Asia, for example. I mean, that's a massive blow up. Obviously on the short side in the first quarter, we had some epic blow ups in the hedge fund community from the short side. So what do you think about all that?
Well, I think that's absolutely true. And I think there's two factors that drive that, right? Remember, anytime you add leverage to a system, you are creating the potential for forced behavior, right? So if I have leverage and my collateral falls, I can be forced to liquidate my position. That contributes to the blowups that you're talking about, right?
That, by the way, sorry to interrupt you, that is literally when my kids come of age, like I always say to my wife, once they're out of kindergarten, every single McCullough child, 4 times I've done it, I have 4 kids, have to learn that lesson through a round of speed Monopoly, where the clock, where the time runs out. And they all get it. But people on Wall Street, you go to the real world, they still have their nose stuck in their 4.0, whatever GPA and textbook. They don't quite get that math.
Well, there's if you're still referencing your 4.0 GPA, you haven't been doing this long enough, and therefore you have not yet learned that lesson from the McCullough household, right? I can assure people that I actually don't even remember my GPA at this point, but nor was it a 4.0. That much I do know.
I had the lowest SAT score in my class at Yale. That is being confirmed officially, but not. So I'm with you on that, man.
I will absolutely support you on that. I think there's pros and there's cons associated with the book smarts. So that dynamic of forced behavior, people tend to forget. And the thing that honestly that scares the hell out of me right now is hearing billionaires promoting highly volatile stuff and trying to convince people that the dollar is collapsing, right? Cash is trash, and that you should go out and mortgage your house so that you can buy XYZ. Like this is bad advice. I don't know what these people think they're doing at this stage, right? Because you're putting people into a position where they can't be in a position to actually make thoughtful decisions when you're facing that type of stress. Just don't do it. Right? This is not a game where everybody should be trying to get rich on the next trade. You accumulate slowly.
Yeah.
And that is boring and unexciting, and you should approach everything with a degree of humility and uncertainty around it. And I'll tell people candidly, could I be wrong on Bitcoin? Of course I could be wrong on Bitcoin. Do I care? No, I really don't, because I'm not short 200% of my net worth in Bitcoin. I just don't care.
Yeah. No, I mean, so when you so let's just ride that for a bit. And we'll use Monopoly because it's a good analogy. People get it. There is no clock. We're not playing it like I do at home with a little vino, watching the kids, do what they'll naturally do, trying to beat their siblings, and they'll blow up every single one of them. Now the game goes on for as long as it can go until Dad's done the bottle of wine. Maybe we'll just keep playing. And you lend money infinity to everybody at the table, and you have nobody left to lend to. The dog my dog Boomer's got a pile now. He's sitting there, and maybe he's going to get long something for a YOLO.
It's always a chance that Boomer wins, right? But
there is good chance.
The reality is that when you YOLO, right, by definition, you're engaging in a highly speculative trade that almost by definition means that you're actually going to get wiped out. Right. And the interesting thing about a lot of the products that exist on Wall Street, and again, I've had conversations about this with many people, our products are actually built, Wall Street builds its products for the most part for the get rich slow crowd, right? Or the already rich crowd is actually who the products are really designed for. There is an element of desired speculation, particularly amongst the younger generation, where they are taking a fraction of their paycheck, right? So they have a continual inflow and basically saying, okay, I want to speculate on this because it changes the outcomes. Historically, that would have been done in an entrepreneurial context, right? In the age of 20, we all know people who did this over and over and over again, who started entrepreneurial venture after entrepreneurial venture from their teens through their 20s. And some people struck it extraordinarily rich, and most people ended up having to go to work in the corporate sector and slow down, right? That's an inevitable progress for Gen Z. I think the thing that I find so confusing or concerning is maybe the more important way to phrase it, is that the language that is used today is increasingly around the dynamics of, if I lose, it's somebody else's fault, right? The only way this trade can lose, the only way the dollar could, that I could not end up making this is if the U.S. government attacks me in some way, shape, or form, right? It's a really scary narrative, and I have hints around where that narrative is emerging. I think it goes to, you were speaking earlier with Grant on a question about the dynamics of the fourth turning. The loss of trust, the evidence-based bad behavior by officials, regulators, et cetera. There's a weird dynamic where I think people increasingly say, the system is rigged, therefore I can't lose. And if I lose, it's because the system is rigged against me. Therefore, I lash out violently. Not a good setup. That's not a good setup.
No, it's crazy. I mean, it's like some very basic concepts like that Wall Street, like bullshit concepts, that asset managers have been pumping forever, since the beginning of asset management, like buy and hold has morphed into hodling. I know you have views on that. I mean, okay, we call it something else, but it's still the same bullshit.
No, 100%. I actually have very specifically made exactly this point. And there's a number of academic papers that have come out recently that are actually highlighting what's referred to as a loss of elasticity in the market, right? So elasticity in an economic sense is the responsiveness of price to changes in supply and demand. Mm-hmm. One of the ways that you make markets less elastic is you encourage people to never sell, right? So there is no price at which you should ever sell this, right? You and I look at that and we're like, that's crazy. I mean, that makes no sense whatsoever. But ironically, the more you do that, the more you convince somebody in Bitcoin to hodl, the more you convince somebody in a Vanguard fund to hodl, the less elasticity you're going to have.
Well, that's a real succinct way to put it. I mean, but at the same time, we have these like big time kind of proclamations of faith. I mean, you can use Mike Saylor, who owns, I think he owns Hope.com.
5 billion, whatever.
Hope.com. I mean, Hope's not a risk management process, and neither is hodling. I mean, or Novogratz, who knows better. Nick Novogratz. Yeah. I mean, I sometimes think about inviting him on this show, but then I wonder, what are we talking about here, Mike? Like, this is not how you talked about risk managing macro markets for your entire career, but now it's all about emphatic statements on Twitter and being famous for Bitcoin. Like, I don't get it. And some people get really pissed off when I say that because you can't call out Mike or whatever. It's like, well, I am calling it out. I mean, you know better than that, Mike. That's not the way the world eventually and always works.
So my pushback on that, and I know Mike. I consider Mike a friend. He's an enjoyable individual to hang out with. Actually, an incredible amount of fun to hang out with.
Yeah, I heard he's a great guy. I mean, he's not my buddy, so at least I chirped him a little bit.
But the point that I would make broadly around this is I don't think that Mike is actually talking about trading. I think what Mike is actually doing is he has an operating business in Galaxy Digital, and he's effectively hyping that business.
Well, that's it. That's okay. That's the answer. I mean, because that's very obvious to me. The Mike Novogratz that I knew was somebody that was competing with me on the buy side, and I think he was a Princeton wrestler or something like that.
Yeah, he was a Princeton wrestler.
Yeah, and
SEL
hockey players like to start fights with Princeton wrestlers. It's okay, but I mean, I actually thought that he was just like dismissing the rest of the universe, but it sounds like not at all.
I don't think that's the case. I just think in the same way that any entrepreneur is going to tell you that their business is a phenomenal business. I think there's a degree of that's going on.
Yeah,
and,
okay, that's fair.
It's important to separate crypto, the asset that individuals can invest in, and crypto, the business model, where investment banks and services, et cetera, are being built up around that. And I would be very surprised. I certainly don't have transparency into any individual's balance sheet, et cetera, but I'd be very surprised if the vast majority of his crypto wealth is actually not tied up in Galaxy Digital as compared to any underlying commodity like a Bitcoin.
Yeah, I mean, Fortress, for that matter, they've done really well with that. I mean, they did, and they bought basically the whole pile last time Bitcoin had a sustained collapse. So it's not like they didn't take a position with real skin in the game. So you got to appreciate that. But I meant more so like maybe the evangelical component to it. And yes, Chamath may be a better example, or Chamath, whatever they call him. I mean, you're just going off on, like, he's calling short selling basically what he does on the long side of his SPACs. It's like, he's like, you can't do that with short selling because clearly you're trying to get something to do something and then take advantage of it. Like, well, what are you trying to do when you're trying to bring these SPACs public? I mean, these are big, like, these guys, names like that. Novogratz is not a new name to the market. That guy is.
Well, Yeah, no regrets is not a new name. Chamath is a new name. For me, SPACs are I think you've heard me talk about this, but SPACs are an index arbitrage play, right? So the rules of index inclusion for Vanguard, BlackRock, things like the total market index, a SPAC is a cash instrument, and it's a cash arbitrage instrument where effectively there is no risk until they make an operating acquisition. Once they make the operating acquisition, then things begin to change. You actually get to vote. Do I get a return of cash? Do I contribute my cash, hold the shares, et cetera? The rules of index inclusion are such that there is an arbitrage associated with IPOing through a SPAC versus a traditional IPO process. A traditional IPO process will typically mean that a company isn't eligible for index inclusion for 6 to 12 months. Mm-hmm. That means you're exposed to multiple earnings cycles, et cetera. For a SPAC, you're eligible for index inclusion in as few as 5 days. And so what that means is that if you can get people to approve the operating acquisition and it hits a certain size, it needs to be somewhere around $1 billion, which can be accomplished through pipes, et cetera, secondary sources of capital in addition to the SPACs. Slightly different, but the details don't matter for this discussion. You can create conditions under which Vanguard and BlackRock are going to have to start to buy. And that's what you see if you look at the largest holders and who's buying in things like a Nikola or other SPACs that are very dubious in Clover Health, if you want to pick on Chamath. Buyers are the Vanguards, right? Yep. It is the mom and pops who have absolutely no idea what's going into their portfolios. And the critics like myself of this process, we can highlight that, but the simple reality is that, in terms of the aggregate impact on a Vanguard fund, it's negligible. Right. So you have this very weird dynamic where it would seem like these giant market moving events and, companies coming public with, 20, 30, $40 billion valuations that feel like they should be, deeply significant. At the end of the day, remember, a $20 billion company is less than 1% of an Apple. Right. It just has no impact.
Mm-hmm. You've dominated on this topic on passive investing, obviously. That's actually what if you don't mind, I'm going to start asking some of the questions. First question has to do with that. I mean, just because it's about the flow. It's not about what's right or wrong, or like use Nikola as an example. I mean, here's a company that quite literally pushed a truck down the hill and said that they have an electric vehicle.
And the crazy part is it still has almost a $5 billion valuation.
Right.
I mean, just stop and think of that and look at who's buying.
Yeah,
you can pull up the holders list. You can toss it up on the screen, and you will see that Vanguard is out there buying. They bought 1 million shares in the last quarter.
Yeah, it's an amazing time where, again, we spent a fair amount of time talking about people in the hedge fund business and the challenges of running neutral with leverage and a lack of liquidity. But you've been carrying the big flag on passive for a while. That's a place where. That's clearly not something that I'm the expert on, but I'm going to ask you the question on it from somebody else because they believe you are. Steve from Whitby. I think that's Whitby, Ontario. That's a great hockey town. Mr. Green, with so much passive money flow artificially, systemically driving prices higher, who's on the other side of the passive trade exit when when the shit hits the fan, basically, you said?
Who's on the other side of the passive trade when the S hits the fan?
Yeah.
So that would imply that there's shorts on the other side of it, right? So like that, I'm not entirely sure the question matches the market dynamic, right? Because passive is going to be somewhere around 40% by market cap if I include all the different components, slightly higher than that in the US, about 44%. Short interest on the market is typically only 1 to 2%, right? So like there is really nobody on the other side of this. Like in general, it's just important to recognize that while there is a buyer for every seller, at the end of the day, we're talking about asset values and they are broadly being inflated. So when you say who's on the other side, I'm not sure it means exactly what you think I'm not sure it means exactly what the question would imply that it means. Are there people who are positioned to take advantage of this? I think so, but in all honesty, again, you go back and you look at many of these companies, and I would suggest that some of the hedge funds that are following alongside are probably wise to it as well. Like it's easier to participate and benefit from those dynamics. I mean, I would highlight the Tesla inclusion last year. The single biggest winner, aside from Elon Musk, was probably Millennium, who has an incredible business around index arbitrage. My understanding is they made somewhere in the neighborhood of $3 billion last year on that one trade.
Yeah, I mean, my answer on this is actually people who use, I humbly submit, if you have a macro level of awareness about the quads and what economic quad you're going into, i.e. what factors are well bid and which ones are for sale, you can really dynamically set yourself up, A, not to get run over on the short side of Tesla or Nikola, not to equate the two, but again, two stocks that people have been royally squeezed in, and B, come back to on the short side when they're in the quads that they go down, where the machine is actually, and the flow is actually a net seller. Because they're chasing other things. So there are a lot of, Clover's a good example. When small caps went from, in quad 2, which you can buy any high short interest flaming POS in quad 2 and you're going to make money, that was the high in Clover for Chamath, and then all of a sudden quad 3, small cap as a factor exposure is an underweight or short. The machine is selling it to chase large cap. Then Clover started to work again. So you got to be macro aware, quad aware is part of my answer on that. The second question has to do with passive as well, Mike. What happens from Ito? What will happen to the passive investing hypothesis in an inflationary environment?
So this is again part of the reason why I'm less concerned about the broader dynamic around passive. The only area you should be concerned about inflation in terms of impacting the passive thesis is actually a function of how does the Federal Reserve respond to it, right? So if the Federal Reserve changes its behavior pattern and is forced to begin to acknowledge inflation and hike interest rates, then you're creating conditions where think about a target date fund, for example, right? The Federal Reserve hikes interest rates, bonds fall in price. A balanced fund, by definition, is going to be buying more bonds to restore them to the underlying level that they're supposed to be in the portfolio, and that robs energy from the equity market, right? So increased marginal flows go into bonds under those conditions, not because some passive strategy thinks that bonds are suddenly a better deal, or because interest rates are higher and that makes them therefore more attractive, but simply because the weighting in the portfolio has been shifted.
Yeah, I think if more people just thought of the flow that way, they would ask less why. People get so caught up on why. It's actually when in that circumstance and how it flows that matters.
Well, I would just emphasize it's a dynamic system, right? So if the Fed starts reacting in a different way and it stops using monetary policy to support asset prices, which they kind of have to do, right? I mean, people have heard me talk about this, but we have turned the markets into a utility. In the same way your electric company delivers electricity to your house, markets are now supposed to deliver retirement to your portfolio, right? As long as that becomes the primary focus, you're going to see lots of impact and a lot of people who are ultimately confident that there is something like a Fed put. What inflation has the potential to do is rob the Fed of that degree of flexibility.
Yeah, that's
again.
Really
I'm not an inflationist. I ultimately think that there's a lot of deflationary characteristics that are embedded inside the markets, ranging from the influence of technology to, much more importantly, the dynamics around demographics, which have only been enhanced by the pandemic. Right? We've seen birth rates plummet all over the globe. Even as people had argued, people are stuck at home, they're going to find more entertainment by having sex and then having children, right? The costs of raising children in a pandemic environment where we have shut off access to many of the services and parents have to consider staying home because their kids are unable to attend school. Man, there is no better solution for, better form of birth control than being forced to stay home with your kids.
That's awesome. Yep. All right. So just, you're gonna have to transition to get my head back on. I'm 46 years old with 4 kids. I get it.
Absolutely. Mine are almost out of the house. I love them, but yes, that is the best form of birth control.
Oh boy. On the closed, okay, so your answer is like, don't forget, this is not a closed system, right? Like it's an open system, this is America, markets, et cetera. But in China, we only have really time for one more topic here. You have a closed capital account. Let's just start with that. You have communists that are perpetuating that and probably not looking to change that. You have a fixed currency rate. But this next question really kind of gets into, what is closed, because I think I'm assuming you said this is Buck Jones from Aspen, Colorado, by the way, great name. Mike, I really enjoy your Real Vision interviews, and one of the recent ones you mentioned that you came across a tweet that had you alarmed and made you think that, you think about the question, what if China never reopens?
Yeah,
that's a real closing, closed system.
Yeah, no. So I'm increasingly convinced that's right. Unfortunately,
what do you mean, like close? Like how?
Nobody allowed in, nobody allowed out.
Sounds like Macau.
It's yeah. I mean but that's the model, right? And so I had highlighted this a couple of years ago, and I just direct people to, there was an awful lot of dialogue around Xi and numerology, and the idea that he was obsessed with the perestroika dynamics, the collapse of the Soviet Union, right? That it was on the 13th five-year plan, and that China was approaching the 13th five-year plan, and therefore they wanted to make sure that they didn't go through the restructuring that could have caused the collapse that Jim Chanos and so many others, in my opinion, actually correctly pointed out that they were engaged in tremendous amounts of malinvestment. By choosing not to engage that, they effectively chose an alternate path, which is the same one that Stalin chose in the late 1920s, early 1930s, that effectively closed the Soviet Union for, give or take, 50, 60 years, right? And I think that's the direction that China's gone. And I think it's I can no longer travel to China. I certainly am very aware of that. I would suggest it is increasingly uncommon for Western businesses to want to put money into China, because if they are thoughtful about it, they're unlikely to get that money back out. They are increasingly trapped in their ability to actually say that, right? Canada speaks up and tries to honor an extradition treaty with the United States and has its citizens held hostage, right? There's no corporation on the planet that's going to send their senior executives to China without significant guarantees of their security. Is China going to take Tim Cook hostage? Highly unlikely. But would they take mid-level employees because a company stood up and said, hey, we received unfair treatment in this region of China? The answer is probably yes, right? I mean, companies that currently have large quantities of cash in China, my understanding is that they struggle to repatriate that the access to borrowing, that effectively they are borrowing to gain access to that as compared to being able to pull cash out of China. I think the next step in that is highly likely that we see a dramatic deceleration in the exchange of individuals, students, et cetera. And we're seeing this. And it feels very much like that thesis is intact.
That is frightening. I mean, but you also have the entrails of that. I mean, it's not like they haven't closed down their social media communication loops. They're U.S. listed companies going inward on that. They still have northbound, southbound connect, but that's not what we're talking about here.
That's a fiction. That's like saying capital flows between California and Nevada, right?
It's like but that would also, if it were, like, let's say you shut down China tomorrow, nothing leaves, nobody gets in, nobody gets out. That's inflationary. I mean, and that's also very bullish for people, for the repatriation of things that we've outsourced to China in both the U.S. and in Europe, and would incrementally at the unit level provide a lot of demand for a lot of companies that otherwise have had to deal with competing with the Chinese.
Well, I would argue that it's inflationary in some sectors of the economy, right? So I had a Real Vision discussion with Louis Gave. We talked exactly about this. That would actually be deflationary at the commodity level, right? Because China is an intensive user of raw commodities. It would almost certainly be inflationary in terms of a margin pressure dynamic, cutting off significant sources of supply that are currently sourcing out of China, for example, right? Bad for businesses like Amazon that exist largely because they are sourcing, the overstatement, I didn't mean it exactly that way, but who are sourcing significant quantities of cheap trinkets at discounts from China. Those are areas of the economy when you talk about things like mass consumerism, right? I mean, at the end of the day, like how many additional sets of plastic outdoor glassware do you really need, right? Or how many sets of disposable patio furniture do you actually need? Do you really need to change it every 3 or 4 years? Those are areas that perversely feel like could be stimulative, right? For a place like North Carolina, which has lost most of its furniture business, could that be reintroduced? Hard to believe that that's going to be a quick recovery process, because rebuilding that skill set is much harder than taking it out. And it also suggests that when you go to the store and you try to buy patio furniture, instead of it costing $1,000 for a set, it's going to cost $5,000 for a set. And that's going to mean that instead of buying it once every 3 years, you buy it once every 15 years, right? All of those are, yes, they are inflationary, meaning that costs go up, but they are also deflationary in that the outdoor furniture store now has dramatically less business.
Yeah, it's another of your many well-rounded and objective answers on. We're attempting to simplify the very complex here. It's just like in any nonlinear system, you have a lot of things you got to think about. I mean, I kept thinking about Brian McGough. I don't know if you know who he is. He runs our retail and apparel research team, and he always tells me, he's like, look, if they shut down a place like China, that's for something like tidy whities, that's a long duration asset. Men change their underwears out like every 7 years. So they can hold on for 6 or 7 more years. And I'm like, okay,
Hopefully they wash them more frequently than that. But yes, I agree with you that there very much is the reaction function, and we all feel it. We go into the store, and so this is the last point I guess I would make on the inflation is that there's an awful lot of discussion around the expectations dynamic, right? Like we are so far from hoarding activity in the West, where people are like, oh, Campbell's soup is skyrocketing in price, and therefore I'm going to fill my cabinets up with Campbell's soup. Like that's just not a realistic appraisal of where the U.S. is in this process. We're still at the point where the vast majority of people are saying, man, Campbell's soup is really high in sodium, and I don't want to eat stuff out of a can. I really want the authentic stuff that was made by an artisan in upstate New York with cows that were lovingly milked for the cream, et cetera. Like we're just so far away from hoarding cans of soup in a pantry that I just don't see it.
I did. Right? I did it. When I did that, I was somehow stuck in the only major snowstorm in Texas history during the pandemic. And the only place that was open was 7-Eleven, and they'd open it anytime they got a new truckload. So, I still have the 2 cans of chunky soup that I bought then. I put them in my pantry. I'm not eating that. And then I go read a book called How Not to Die, and it's like, don't eat that. So
right, exactly. 100%.
So you're just
well, and that's most people watching this know that I've had a very successful year in terms of my diet and personal health, right? But a huge chunk of that was moving away from the calorie-dense processed foods. Yeah. And so my food bill's dramatically higher, right? And it actually perversely leads to all sorts of unintended effects. I don't eat in restaurants as much. I don't, all those things that we've talked about, there are feedback loops associated with it. Even as I'm spending more money on food, I'm eating less, right? And I'm happier about it. So it's, I guess, as you talk about simplifying things, right, which of course the name of my firm, but the reality is that you look for ways to simplify in a very complicated world.
Yeah, and you did a damn good job of doing that across a waterfront of topics, and I knew you would. So thanks for making the time for us. We certainly appreciate it, man.
Keith, thank you again.
He's Mike Green. Awesome, just awesome. That's a wrap for today. We have day 3 coming tomorrow. We hope you join us.